What causes gas prices to go up or down? Lately, with the rise of gas prices worldwide, I've been seeing a lot of takes on this question of what causes gas prices. Some of these takes are really bad, and some of these takes make a little bit more sense. So I looked into economic research on this question: what causes gas prices to go up and down? First, we're going to talk about how it is extremely complicated to answer this question. And next, we're going to talk about what actually does cause gas prices to rise and fall. First, you should know that it's extremely complicated to answer this question. It is so complicated that when I started looking up information about what causes gas prices to rise and fall, the first research papers I found were just about economists saying to other economists, we're never going to know for sure what causes gas prices. Even the economists who study this issue their whole lives cannot say for sure exactly what causes gas prices to rise and fall. Here's a quote from one of the articles I found. Generally speaking, fluctuation in the oil market is somewhat random and unstable. These were the people that were claiming to have made a model to predict gas prices, and even they said gas prices are basically somewhat random and unpredictable. Economists do know some of the biggest factors that predict gas prices, but the catch is economists, first of all, don't know all the factors that cause gas prices. Even when they put all of those big factors into their mathematical models trying to predict gas prices, there's some percentage of the model that is just uncertain. Then, on top of that, they hardly ever know exactly how much each factor is going to matter in terms of predicting gas prices. One thing that I read over and over is that it's a lot easier for economists to look in the past, in hindsight, and to say, we think this thing really was the cause of gas prices at this particular point. But if you're looking into the future trying to predict, it's almost impossible for economists to actually predict this event is going to cause higher gas prices or lower gas prices. So now let's answer the question, why is it so complicated? Almost all of us who are interested in economics know the basics of supply and demand. Shouldn't gas prices follow the basic laws of economics? Well, here are some of the reasons why oil prices are so much more complicated than other prices in the regular economic marketplace. One is that there are unexpected shifts in oil demand. For example, one of these researchers talked about how since 2003, China has grown a lot faster than economists predicted and therefore needed a lot more oil or gas than economists predicted. They also talk about how there are unexpected shifts in oil production itself that will dramatically change prices. For example, the Libyan civil war that started in 2011 made it extremely complicated to get oil out of Libya all of a sudden. Nobody had predicted a civil war in Libya, so nobody had any idea that Libyan oil was suddenly going to be a lot more difficult to get. Also, some researchers pointed to events such as the discovery of new oil fields in the late 1970s, when nobody had any idea how successful these searches for oil would be. Everyone knew that major oil companies were searching for new oil fields, but nobody knew if they were going to find it or not. It's kind of like just finding buried treasure. Maybe you'll find it, maybe you won't. These sorts of searches make a huge difference in oil production and what the emerging oil market is going to look like in the future. And yet, that is something that nobody can predict. So now that we've talked about how difficult it is to predict the price of gasoline because there are so many factors that are so complicated, let's talk about what factors researchers have found that actually are important. So here's one: political events in oil producing countries that change crude oil production. It can be something like the political leadership changes. It could be something like a civil war, which obviously people can't predict with very good certainty. It can be a change in the relationship between one country and another because of some kind of political event that nobody saw coming. There are all kinds of political events that can affect oil producing countries, and they aren't very easily predictable. Another factor that a lot of researchers cite is OPEC. OPEC is spelled OPEC, and it stands for Organization of the Petroleum Exporting Countries. Saudi Arabia is the de facto leader of OPEC, even though officially every country in OPEC gets one vote per country. Most of the countries tend to follow whatever Saudi Arabia says. The other members of OPEC are Algeria, Angola, Congo, Ecuador, Equatorial Guinea, Gabon, Iran, Iraq, Kuwait, Libya, Nigeria, Qatar, United Arab Emirates, and Venezuela. Now, these countries are all oil producing countries, and they have banded together to control the price of the oil that's coming out of their country. In fact, they control about 44% of worldwide oil production. So, when that group decides to raise the price of oil or lower the price of oil, it affects all of our lives. Another major factor that researchers point to is unexpected changes in the demand for crude oil. For example, researchers have found that 50% or more of the price of oil or gasoline at the pump is driven by emerging economies suddenly having more demand. Developed countries use twice as much oil as emerging countries, but it's the emerging countries and what they need, their oil needs, that are more likely to cause shifts in prices. The reason is that developed countries are pretty stable. Usually it's pretty easy to predict exactly how much gasoline the United States is going to need or how much England is going to need, because these countries have been very stable for a long time in the amount of oil that we need. We might go up for a while or down for a while, depending on factors. But in general, the amount of oil that we need is very stable. In contrast, in developing countries, they can have this dramatic shift in politics or economics or a technological breakthrough or whatever, and all of a sudden incomes shoot up in that country, and all of a sudden there's a huge demand for oil that wasn't there before and that people didn't predict before. But that is one of the major factors that changes how much gas costs for us. Another major factor is the stock market or general economic inflation. Oil is a commodity, and it's traded just like other commodities, and it is tied to the global economy. So as the global economy goes up or down, as there are recessions or depressions or inflation, the price of oil is going to change along with those. So this isn't talking about the price of oil itself being the driver of the change. This is other economic factors being the driver, and then the price of oil kind of tags along and changes along with those other factors. Another major factor in the price of oil is the seasonality. Oil prices rise in the first quarter of the fiscal year, then they peak in the second or third quarters, then they become very volatile, and then they fall again in the fourth quarter. This pattern is so normal that it will even overwhelm other factors that you would think would be more important. So even if other things in the world are pushing the price of oil down, if you're in the second or third quarter, the price of oil is still likely to rise anyway, or vice versa. If there are other factors in the world that are pushing the price of oil up, then it's still likely to fall in the fourth quarter no matter what. So seasonality is actually one of the most important predictors of the price of oil. And one last major factor that researchers have found when they try to predict the price of oil is the feelings of investors. I know that this is really hard to pin down, but very often investors will have a feeling that oil is a good investment right now, or that it's a bad investment, or they get scared of investing in oil, or they start loving investing in oil. And those feelings end up changing the oil pricing quite a bit. The price of oil should be based on fundamental values like production and demand, but instead, researchers have been able to prove that speculative trading changes it a lot more than they would have predicted. There are often very large errors in forecasted demands for oil, and investors react to those incorrect forecasts. So, investors have bad information, and everyone reacts in one way or another that changes the price of oil, as these investors are essentially betting. They're betting on whether oil is going to be worth more or less in the near future, in the far future, or whatever. They're making bets based on what they think is going to happen in their own feelings. For example, sometimes there's a sudden demand for oil in above ground storage because of a fear that in the future there won't be enough oil. So people become scared of this, sometimes rationally, sometimes irrationally. They buy up all the oil that's already sitting in big tanks waiting to be bought. And all of a sudden, everyone's buying up the oil, and the price of oil changes because of that fear, when the fear really might not have been founded in anything. And the thing that people were afraid of might not actually come true at all. Most investors in oil have all the same basic facts. Everyone is watching the news, they're watching the same information unfold in front of them. So, experts often expect them to behave rationally in response to the facts. However, investors disagree about how to interpret the information they have. So, some people will look at a fact and they're kind of optimistic, glass half full kinds of people, and they say, aha, everything's going to come up sunshine and roses and puppies very soon. So, this is how I'm going to invest. Another investor looks at exactly the same facts and they're kind of a pessimistic, glass half empty type of person, and they say, oh no, everything's about to fall apart. So I'm going to invest in this other way over here, preparing for disaster. Researchers have been able to find that this kind of investor feeling can create action, which then creates booms and busts in oil prices. And these booms and busts may have nothing at all to do with reality, like how much oil there actually is, or how much demand there actually is, or how much oil there actually is in the ground. Nothing to do with reality. So let's summarize. Is your president to blame for oil prices, for gas prices? No. I don't care if the president is Republican or Democrat. That is not to say that presidents can't do anything to change gas prices. They can do some. They can release some gasoline out of reserves, for example. They can make speeches and try to pressure OPEC. There are some things presidents can do to influence gas prices, but all the research that I've found indicates that, for the most part, gas prices are fundamentally being driven by factors that have nothing at all to do with a president or a political party. And there is very little that any president or political party can actually do to influence gas prices, especially long term. A president might be able to make some little speech that might change OPEC's mind a tiny bit short term, but all the factors that influence gas prices overall, fundamentally in the long term, all of those factors are factors that are completely out of the hands of our politicians.